There's a saying in markets when everyone is looking in the same direction, the smart money starts looking the other way. And right now, everyone is looking at defense stocks. You know the names HAL, Bell, Mazgow, BDL, Paras, IdeaForge. It has been an absolute rocket ride. Some of these stocks have doubled in the last year. Others, like Mazgow, have gone up over 6 times in the past 24 months. Every brokerage is bullish, every news headline screams India's defense decade, and every Telegram and Twitter group is overflowing with charts and conviction. And there has been a massive increase in retail shareholding in these stocks. But here's the question I want to ask today. Are we looking at a genuine structural breakout for India's defense sector, or are we just in the middle of a very convincing narrative bubble? Hi, I'm Pranshumaan Singh. I've spent over a decade in corporate finance and investment banking. I've advised on billion-dollar M&A deals and seen how themes come and go, how cycles turn quietly while the noise is still loud. And on this channel, I try to give you the kind of clarity and context that I wish I had when I was starting out. If you're new here, hit that subscribe button, join our Telegram group. We unpack trends like this in real time. And if you're thinking about a career in finance, do check out our NISM 10th A course linked in the description. Alright, let's get into it. Let's start with the basics. Why are defense stocks rallying? The short version is that India is becoming more reliant in defense manufacturing. The government has banned imports on over 500 items. HAL is building fighter jets, helicopters, even satellite launch systems. Bell is exporting radar systems. India's defense exports crossed 21,000 crore rupees in FY24, which is an all-time high. And for the first time in decades, Indian defense PSUs are not just executing on orders, they are actively shaping the defense supply chain. Add to this the global backdrop, Taiwan, Ukraine, Iran, and just general geopolitical uncertainty. Governments across the world are raising defense budgets. Sovereignty and security are back in fashion. And in India, that means one thing, more money flowing into HAL, Bell, and their peers. So sure, the optimism is not completely baseless, but here's where it gets interesting. When you actually look at the numbers like valuations, earnings, execution timelines, a different picture emerges altogether. Let's start with HAL, Hindustan Aeronautics, everyone's favorite defense stock. HAL has an order book of over 94,000 crore rupees, which is no doubt big. It is executing on a wide range of platforms from helicopters, engines to satellite launch vehicles. It is arguably the most strategic PSU in India right now. But here's the thing, in FY24, HAL's profit actually dropped. Net profit was down by 8%, primarily due to delays in Tejas aircraft deliveries. On top of that, HAL trades at a PE of 36 to 38 trailing, depending on which quarter you look at, which is very rich. For context, HAL's ROE is still under 20%, which is not a capital light compounder. It is a heavy industry PSU with 5 to 7 year project cycles. When you buy HAL today, you are essentially assuming that these massive order books, which will translate into steady, margin accretive earnings year after year with no hiccups. And that is a brave assumption, especially for a company where one delayed defense program can throw off earnings by 500 to 1000 crore rupees. Let's move on to Bell, Bharat Electronics. Now, Bell is interesting because it is positioned as a modern defense play. It makes radars, communication systems, and has started pushing into exports. It also recently received 3,500 crore rupees in fresh orders in June alone, which sounds very impressive. But once again, look at the financials. Bell's FY24 net profit came in at around 3750 crore rupees. Revenue was roughly 20,000 crore rupees. That is around 10 to 20% top line growth, which is healthy but not earth shattering. And yet the stock trades at over 30 times earnings, again for a PSU with a single client, the Ministry of Defense. So let me put it another way. The market is valuing Bell at a higher multiple than ICICI Bank. And while Bell's export story is exciting, it is still a small percentage of the overall business. The real question is, can Bell scale beyond the Indian government? Or are we just extrapolating short-term orders into a 10-year growth story? Now let's talk about Mazgow, probably the most misunderstood stock in the rally. Mazgow has been the multi-bagger that nobody saw coming. In 2022, it was trading at under 300 rupees. Today, it is over 22,000 rupees. It is over 2,000 rupees. That's a 6 to 7 times move, which is incredible. But let's zoom in. Mazgow is a shipbuilder. It builds destroyers and submarines. That means huge contracts, but also lumpy revenues. 1 or 2 contracts can dominate the entire financial year. Execution takes time. Margins are stable, but not spectacular. In FY24, profit came in at around 1400 crore rupees. Margins stayed flat, ROC is decent, but growth is not linear. And yet, the stock now trades at over 35 times earnings. Why? Because of float. Mazgow has very low free float. So when demand spikes, whether from mutual funds or retailers, the stock just flies. But that is not sustainable. That is a structural inefficiency, not a reflection of business fundamentals. Then there is Bharat Dynamics, the missile manufacturer. Very strategic, very important, but very concentrated. All of its revenue still comes from the Ministry of Defense. FY24 earnings were up about 16%, but volatility remains. BDL's valuation is now in the mid 30s on a PE basis. Again, quite rich for a one client defense contractor. And on the small cap side, we have Paras Defense and Idea Forge. Paras is a classic retail favorite. It trades at a triple digit price to earning. It does a bit of optics, a bit of components, a bit of defense integrations, but profits are small. The equity story is based more on buzz than on balance sheet. Idea Forge, meanwhile, is the drone darling. It just got a 137 crore UAV order from the Ministry of Defense. And yes, drones are the future, but this is still a 2000 crore market cap company with lumpy revenues and very fragile order pipeline. Great story, but not really a great business yet. Now, all of this brings us back to a central question. What exactly is the market pricing in? Because based on earnings alone, none of these stocks deserve to be trading at 30 to 40 times multiples. These are not platform businesses. These are not recurring revenue SaaS models. These are PSUs with complex project cycles, high client concentration, and tight government control. And that last point really matters. Let's say HAL or BEL report a record profit next year. Fantastic, right? But guess what happens next? The government steps in and says, great quarter, now pay out 40 to 50% of that as dividends. That is less money for R&D, less money for global expansion, and less flexibility for management. It is not just about earnings, it is about capital allocation, and PSUs don't get to make those decisions freely. On top of that, there is the fact that none of these companies are going to be privatized. Unlike PSU banks or airlines or power discoms, there is no plan, not even a hint, that HAL or Bell or Mazgow will ever see management autonomy. That means bureaucratic inertia stays, and government policy, not market dynamics, will keep dictating their growth trajectory. So yes, the rally is exciting, the order books are real, and India's defense posture is genuinely changing. But does that justify 35 times multiple across the board? I am not so sure. Now, to be clear, I'm not saying that defense is a bad sector. Far from it. I actually believe that it's a long-term story. But I also believe that markets are forward-looking, and sometimes too forward-looking. Right now, defense PSUs are being priced as if they will turn into India's Lockheed Martin or Raytheon in the next 3 years. But here's a reality check. Even Raytheon, a global tech integrated defense giant, trades at around 20 to 22 times earnings. And it has a multiple revenue streams across private and public clients. HAL, Bell and BDL, well, they are nowhere near the level of diversification, capital efficiency or operational freedom. So if you have invested already, congratulations, you've probably made great returns. But now might be a good time to get disciplined, rebalance, trim overweight allocations. Don't let excitement override valuation logic. And if you're sitting out, that is okay. These are cyclical, capital heavy stories and they will come back to fair value eventually. You don't have to chase a stock just because everyone else is. Because in the end, investing is not about joining the party. It is about leaving before the music stops. If this video helped you think more clearly about the defense rally, drop a like. Subscribe to the channel and share this with anyone who's caught up in the PSU hype. If you want deeper discussions like this, join our Telegram group. The link is below. And if you're interested in building a career in finance, consider enrolling in the NISM 10th course. We've helped dozens of people transition into meaningful regulated advisory careers, and this could be your next step. Until next time, invest smart, think independently, and remember, narratives make the noise, but numbers tell the truth.